On September 17th, the key Federal Reserve meeting took place, where a new cycle of interest rate cuts is expected to begin. This will have significant implications for the prices of stock market assets, commodities, currencies, and the overall economy. We are in a complex moment, and this live session will explain which stocks will perform well. It's all about learning to navigate these upcoming economic changes that many people may not be prepared for or lack full information about it. That's why we prepare this document to explore why this meeting is so important, why it marks a turning point for the global economy, what it means for the future of the stock market, the risks investments, and which companies or sectors will be negatively or positively impacted, backed by data and the best possible analysis. So, if you are investing in the stock market or just starting out, I recommend watching this in full because you'll gain valuable and useful insights to help your investments. Before we dive in, it's crucial to understand Warren Buffett's quote about interest rates and why they are so critical and closely watched. It's important not to get distracted by geopolitical events, conflicts, or one off news. However, interest rates are the most important factor for investors if we want to protect or grow our money. Buffett says interest rates are to asset prices, whether stocks, commodities, or real estate, what gravity is to Earth. They control everything and affect all valuations. When interest rates are low, gravitational pull is weak, allowing prices to rise in the stock market, and they are the most important element in valuations over time. This gives us an idea of their immense importance. Here, we see a different cycles of rate hikes and cuts, especially with interest rates so high, and now the previous rate hikes caused volatility. A new rate cut scenario is expected, historically associated with bullish stock market conditions. But we are at complicated crossroads because inflation was rising. Typically, interest rates are cut when inflation is falling or the economy is weak and needs a boost. But now, it's curious that due to the political influence in the US and because the dollar is the world's reserve currency, other central banks tend to follow the Fed lead and will likely see more rate cuts globally. In fact, the probability is nearly 100%. An older figure this was, but now it's at 98.8%. And we just today we saw that the Fed just cut 0.25 points, making this new cycle of rate cuts almost certain. Last Friday, the US job reports came out, and one of the weakest in the last 3 years, adding pressure on the Fed to lower rates to stimulate the economy and avoid job destruction, which is quite negative for the economy. In this new cycle of rate cuts and the emerging global economy landscape, the government seems ready to use all available tools, and there's been notable tension between Jerome Powell and Donald Trump in recent months, with constant pressure. Hey, rates are too high. Inflation isn't high. Inflation isn't as high as in 2022, and this is hurting real estate, a critical global economy driver. Last week, Trump even fired one of the Fed governors who voted, which is significant. People think Jerome Powell decides everything, but it's a group decision. The firing of Lisa Cook was controversial, tied to allegations of benefiting from mortgage loans due to her Fed position, sending a clear message. If you don't align with the rate cuts and vote for them, there will be consequences. This is unprecedented and hasn't happened before. The issue with the Federal Reserve is that Powell is retiring in 1 year. He's already over 75 years old. His career is fully established, and he's achieved all possible success. However, what's being discussed, and it's very interesting, is that the other members of the Federal Reserve Board of Governors have careers to maintain and are obviously also seeking their personal benefit and alignment with the people or the government that can make decisions, which is very important. In fact, here we see a small chart, and obviously there's the Federal Reserve Chairman, but then there's a group of people who vote. So what happens if you apply pressure and say, I can control Powell, but what if I put pressure on everyone else to start changing their rhetoric and begin saying that rate cuts are needed? Because sometimes in certain meetings, it's very divided, maybe 60-40 on keeping rates or working on them. But if I manage to convince a small group, I can change the direction of this. And that's somewhat that's being worked on before Powell's retirement in May of 2026, which is also very close. And there, he'll be replaced by a Federal Reserve chairman, obviously aligned with the vision of aggressive rate cuts and pro-economy policies. However, Jerome Powell doesn't want to cut rates because he's seeing a reality. Here are the latest month-to-month inflation data, and this is somewhat negative. This red trend line shows that in recent months, it's pointing to rising inflation, and lowering interest rates would be like pouring gasoline on the fire. On paper, it would accelerate inflation. This has been mainly caused by the issue of tariffs, one of the most important reasons. That's why the Federal Reserve would have liked to wait longer, but now the pressure is too high. In fact, the question is whether the government can really manipulate inflation data in its favor, because that was the excuse the Fed used. Inflation, there are the problems. And we've seen unprecedented changes in recent months. The first was that a series of scientists or officials responsible for publishing official government data, both on employment and inflation related, were sacked. And recently, Apollo Group, one of the most important and reputable investment firms, published this very interesting chart. Within the famous inflation data, which is used to set interest rates, there's a percentage that is estimated, meaning it can almost be set to whatever one considers. This was normally a very low rate. This was normally a very low percentage, 8 or 10%. And what a coincidence that after the new government, that it came on February or March, this suddenly spiked to 35%. That is almost a third on the inflation data, which you know greatly influence the market every time it's published. And now it's estimated. In other words, you can put whatever you want, and many times. If a third of inflation is estimated, and that figure is 3, you can make it 2 or 2.2 or whatever is desired. So there's talk that we might start seeing better inflation data because, well, since it's estimated, you can publish whatever. Where does this lead us? A scenario like the current one, with rate cuts and stabilizing inflation, means that the price of the real assets will rise because it's an environment of what's called negative real rates. And gold has been factoring in this new scenario for a long time. Since the start of the year, revaluing by 36% from 2600 to 3600. And now all the gold companies have risen a lot. They are at very high prices because people want to start investing in this sector. This chart is the most important for understanding the price of gold. Here, we can see the price of gold alongside real interest rates. So, when real interest rates become negative, okay, This green light is an inverter chart. In fact, there's an almost perfect correlation between real interest rates and the price of gold. So it seems that the new scenario, at least for the next 12 months, is one of inflation and falling interest rates, which the market will reflect in the price of gold. And that's why many investors are buying or investing in this sector, alright? In fact, here we can see that the Financial Times is already announcing estimated price of 5,000 per ounce. Another problem with the high interest rates is the housing and construction sector issue, which in the United States or any country, it's a very large percentage of the economy, almost 10 or 20%. And it's very started in the US right now. In fact, one of the main real estate portals says that for the first time in history, there are 500,000 more sellers than buyers, meaning the market is imbalanced by 500,000 participants, the largest in history. Not even in 2008, with the real estate crisis, when there were many forced home sellers. That's why it's said that housing prices will start to fall. And since most people's wealth is tied up in real estate, especially in the US, this is bad because these people will vote and will be dissatisfied with the government. They'll feel poorer if their home price drop. They won't be able to refinance or take out loans using homes as collateral because they're worth less. And that's also slows the economy. There are a ton of negative things related to this that they want to address. In fact, here we can see in this chart that there are more than 2 million sellers in only 1.4 million buyers actively looking. One of the most imbalanced markets. In 2021, the opposite happened. There were very few sellers and many buyers. So housing prices rose a lot because in the end, it's supply and demand, especially in the short and medium term. There are other indicators. This one is also very interesting, which is the number of visitors to Las Vegas, which is usually a leading indicator of recession or economic weakness. Because when people are short on money, the last thing they do is take a purely recreational trip to Las Vegas to spend money, gamble, and so on. Historically, we see that in the 2008 crisis or the year 2000, it turned negative, meaning there was a decline in tourism into Las Vegas. And here we see that it's starting to happen now in 2025. So this indicator suggests that besides the interest rate cuts, we could see a recession coming if the economy doesn't support this weakness. This is all for today. Thanks for watching and I'll see you in the next video.